Good morning and welcome to the AJ Bell On the Road, Off the Road series of webinars. My name is Gary Dale. I am the Sales Director for AJ Bell Invest Centre, and it's my pleasure to be your host for the next 2 days. Now, everyone online, I'm sure, is aware that the primary reason we're bringing you this webinar content is because of COVID. However, it's been a hugely fun experience for us. I hope it has for you. We've delivered and produced more than 20 of these webinars thus far, and more than 8,000 of your very good selves have chosen to log in and join us to hear this content. So we've had a great experience doing it, and hopefully a lot of learning has been taken from it. However, we do appreciate that the pressing of the flesh and the face-to-face meeting, networking with colleagues is still very important. With that in mind, we would hope to be back with you on the road in spring of next year. So keep an eye on your email alerts and our website for more details of future events, dates, times, venues, and content, etc. Now, on that note, some of you online may be thinking, we never got an invite, or we've missed out on these webinars, perhaps one or two. All 20 are on the info centre on our website. You log in the usual way, click the link, and the content is available at your fingertips. Having said that, however, if you haven't been getting the invites, when you complete your feedback forms at the end of these sessions, let us know. We can add you to the invite list, and that will ensure that you get the invites and a heads up on when these events are going to be happening. So this is about 2 days, and this is day one of 2. Today you'll hear from me. I'll give you a very brief update on everything AJ Bell Invest Centre, including what we've delivered over the past 12 months, and of course what's yet to come in terms of platform functionality. You'll then hear from Kevin Doran, our CIO. I'll give Kev and his session a full introduction in due course. If you haven't registered for day 2, I would encourage you to log into the website and click the link, get the invite, and that ensures you'll be able to join us tomorrow for our 2 additional speakers, Lisa Webster and Russ Mould, and I'll give both Lisa and Russ full intros in due course. So without further ado, let's crack into the meat and bones of this first session with me, which is all about AJ Bell Invest Centre. So without further ado, let me crack on and give you all an update on the current position with AJ Bell. Some business numbers, a very brief look at the products, the investments, of course, thanks to AJ Bell Investments and the team with what we have thus far. I'll have a look at functionality, what's been delivered, and more importantly, I guess, from your point of view, what's yet to come. And then we'll have a little look at advisor adoption before we close off. So let's crack on. As I say, strength, products, investments, platform functionality, and are we keeping you guys happy? Let's have a look at strength first of all. For those of you who've seen me present at these sessions in the past, you're probably about to say, but he said this before. The numbers always go up, they never go down. Well, that's probably right since I've joined. But if I think about pre-float and post-float, and I think about the things that are important to AJ Bell, the 2 things that I've consistently mentioned are retail customer growth and AUA growth. They are the 2 things that drive our business and its profitability. And it's hugely important we get the right service proposition to match the delivery of both of those targets. But we think we're managing to do that better and more efficiently each year. So taking these numbers in turn, if we have a look at the number of retail customers, so as at March, which is our midway point through our business year, we're up 22%. That's a healthy number and a really, really healthy increase over that period. And that's matched with a very slim increase in AUA up to 48.3 billion over the same period. Revenue, of course, up 22%, but PBT, the important number, up just shy of 30% over the period. So healthy numbers, and And what we always say is if we can get these numbers right, retail customers and AUA going in the right direction, not only will we be taking care of growth indirectly, but the share price, of course, will take care of itself. So these are the two main focuses and always will be in terms of how we try and grow business at AJ Bell. From a financial strength point of view, we think we keep really, really good company. We are a B+ rated business, rated by AKG, of course. And as you can see from the slide, notwithstanding Standard Life, we adopt the same position as some fairly big providers in this space. And for those who use other platforms, you can see, of course, where they favour in B and in C case if you use premium. But a fairly glossy picture, quite a rosy set of numbers. It's been an awkward period for us, but essentially we are managing to do exactly what we set out to do and continue growing those numbers and growing the AUA. Now, product, reasonably straightforward slide, but I wanted to go through it very, very quickly to highlight a little bit of the story of the evolution. So obviously SIPP was the very first product for AJ Bell, and we moved into Junior SIPP and of course into ISA, JISA, LISA and GIA. There's perhaps a little bit of a jiggery pokery. I'm sure the GIA came before LISA and JISA, but nonetheless, they are the main product wrappers. And we have an affinity with both Utmost and Canada Life to offer our GIA inside their offshore bond wrapper. However, there was always a price point at which AJ Bell became more competitive than perhaps other platforms. And that price point was at 200,000 AUA on our funds and shares platform. And of course, we start our custody service fee at 20 basis points. Now, for customers that were perhaps starting on the pension journey, or less to invest, smaller pensions, smaller transfers, we started to look a little bit more expensive if you added in quarterly administration fees. So earlier this year, in January, in fact, we launched the RIA, the Retirement Investment Account. I'm going to talk a little bit more about that in more detail in just a minute. But the primary reason for launch of that product was to allow advisors to use AJ Bell across family groups without needlessly overcharging customers with perhaps less than that magical 200k price point, or those that were just starting off on the pensions journey. Now, what is RIA? For those of you who haven't seen it before or haven't used it, it's essentially our SIPP without some of the bells and whistles. But more importantly, not looking at what it doesn't have, what it does have, it's an all-in priced product. We'll look at the pricing in just a minute. And it's got a full comprehensive range of investments. That was hugely important. We didn't want to offer a product, especially in SIPP space, that didn't afford the same investment flexibility that our SIPP does. The only exception, of course, is that we don't allow investment partners or, in fact, off-panel. So you can have full funds and share service access, AJ Bell Investment Solutions, of course, third-party MPS, which I'll come to and touch on a little bit later. And of course, the funds and shares service EXO that was added some time ago. And as the normal functionality would have, full access to the full range of pensions freedoms. So a really, really strong addition to the pension stable, the product stable, that has had a huge impact since launch earlier this year in January. Now, why did we look at it? A number of reasons. Obviously, we knew we were losing out on business, and actually it was inappropriate for advisors to recommend the full SIPP product less than that magical price point, because of course you were incurring quarterly admin fees. Prod came along. Client segmentation has been here for a while, and more importantly, matching providers' propositions to client needs. Where advisors had clients with perhaps smaller pension funds and smaller transfers, it was becoming more and more difficult to recommend AJ Bell. So that brought up the more obvious need and brought RIA to the fore, if you like. As I said, it's delivered in addition to the SIPP pricing option, and it's an all-in pricing alternative. So it's 25 basis points up to 500,000 and 20 basis points over 500,000. Now, clearly there will be an overlap, a point at which you may decide that the full SIPP is a better option. You can switch to full SIPP in the future if you so wish. And as it says in the slide, there are no additional charges for setup, transfer in, ongoing admin, dealing, or of course, income drawdown. So a great addition to the product stable. Langcat, I'm sure most of you online will be familiar with the Langcat pricing matrices. It's the old red, amber, green. Anything in green, light yellow, looks really competitive, and it starts to look a little bit warmer the more expensive it becomes. So for the retirement investment account, in an accumulation model, you can see that even at 50k and at 25 basis points, it sits head and shoulders above the majority of the competition in terms of a very, very competitive price point. And as that starts to grow, the green starts to trade down to perhaps amber and perhaps orange. But of course, when you then start to look at the SIPP pricing at 20 basis points and indeed 15 as it goes above $1 million, you start to get into that green territory yet again. So across the board, we've now got a competitive price point for, as we would argue, any self-invested personal pension. That's the accumulation matrix. The drawdown matrix looks very, very similar. And of course, customers in drawdown with RIA will no longer have to pay the £150 income drawdown charge. When you blend and you mix wrapper and you have a blend between pension, in this case RIA, ISA and GIA, the matrix looks very, very similar. The reason it's dropped from 25 to 23 basis points is, of course, our ISA and GIA products are priced at 20 basis points across the board. It's the RIA element of that blend that will push it slightly above the 20 because, of course, it's charged at 25 basis points up to £500,000 and 20 basis points thereafter. Now, investments. Platform ran some great information gathering, I guess, on advisors and what the investment strategies were that you looked to use. Now, most of this will look like common sense. For me, what I've seen in the last 3 years is a real renaissance in the use of multi-asset strategies by advisors. So if we look at that data, which is from May earlier this year, we can see that a huge percentage of advisors are using multi-asset, multi-manager funds or third party. And it starts to drip down 53-41 as you look to outsourcing and then outsourcing to a DFM on bespoke, and then perhaps a very small minority at the end of advisors using in-house model discretionary mandates where they run their own discretionary permissions. Now, for AJ Bell, where we lacked, or the missing link in our jigsaw, if you like, for investment solutions was, of course, the inclusion of third-party DFM as an option. Well, for those of you who've been keeping abreast of our developments, we have gone live with third-party DFM, which is fantastic. It's taken us a while to get to this place, and we're really excited that we've brought these options to you. So in addition to the AJ Bell MPS that you can, of course, access on platform, you can now access Brewin Dolphin, you can access Vestra, and you can access FE. Now, there are more additions on their way. We hope to bring you some very good news soon on Charles Stanley and also Brooks Macdonald. But what I'd say to you is watch this space for new additions. Your BDM, BDC or BDS will keep you up to speed. We will have plenty of email alerts and keeping you abreast of developments as they happen. But I'd be very hopeful of launching an additional 2 in the coming weeks. Now, with a look at costs on our own solutions, this slide, when you're doing it at an OTR, an on the road, is obviously a difficult one to focus on because, for a start, nobody can see it. But it's important to use this matrix for a couple of reasons, because what we do is we're explaining to you that at all times, whether or not you're using an MPS or one of our funds, you pay AJ Bell Investments a single fee of 15 basis points. Now, at the moment, it's 15 basis points on funds, and if it's an MPS, it's currently 15 basis points plus VAT. Now, as you can see, as you look at this matrix, there's the AJ Bell AMC, there's the underlying OCF, which comes underneath, the vehicle costs, of course, and the total. The last point in that line, which is the line in italics, any transaction costs that are incurred. Now, the reason I wanted to leave this slide in is if we look at the MPS 3 column, so with regards to our fund, our passive fund, which is the balanced fund, what we've always said is that, first of all, we'd cap fees at 35 basis points, which is competitive enough. When you look at it in line with our platform cost, you've got an all-in cost at 55 basis points. But as these funds have grown in size, we've always said we'd be passing back the costs to advisors and their clients based on the economies of scale principle. And you can see with the balanced fund that the cost has come down. Yes, it's only a basis point, but the principle is sound. We intend and fully intend to pass these costs back as and when we're able to reduce them based on the size of the investments coming into the funds. So a cap at 35, and as the funds grow, you'd expect to see those total fund costs coming down. So a great message from AJ Bell Investments. And we've got 3 years, of course, now. So when they were launched, it's the usual conversations with centralised investment propositions or investment committees or advisors, always looking for that track record, that ever important 3-year track record. Do you stand up against the competition? Will this new system, will this more efficient modelling of investment assets within a unitised wrapper work for AJ Bell? Why should it? We've always used Vanguard, etc., etc. You can tell I'm quite excited by this. Why? The numbers on the screen speak for themselves. To get these top quartile rankings over a 3-year period, and in fact, when you look back 2 and 1 years, there's only one exception to that rule on the Adventurous Fund with a quartile ranking of 2. Hardly shabby, but it just does make the matrix of ones look a little bit out of place. But we think that's stellar performance. And when you look at the numbers, the actual performance numbers underneath at the bottom of the chart in more detail, you can see that our funds stack up exceptionally well. So for those of you that are aware of them and using them, thank you very much. For those of you who haven't looked at them or weren't aware of them, contact us after it, have a word with your BDM or anybody in the business development team, and we'll make sure we get that information to you. But coming to some of the meat here, this is the bit that a lot of advisors were looking for. It's all very well having our own MPS on platform, but what if that MPS goes off the boil? Are you really telling me that I've got to switch platforms for a customer without switching MPS provider? Well, now we're really pleased to bring you those 3 additional Brewin FE and Vestra additions to our MPS stable. And as I said earlier, we're going to be adding to that in due course with Brooks Macdonald, to name but one, and others I am sure will follow. We like to think of it as a small but perfectly formed panel. I'm aware, and we're aware at AJ Bell, that some of our competitors offer many, many more. But when we looked at the market and we really drilled down as to who those key providers were, we think we've made the right choice. Having said that, please feed into us if there are firms not on our panel that you would like to see us adding. As I've said, more to be added on time, and it's this online portal that allows DFMs to input and manage those portfolios on your client's behalf. It's a low platform custody charge, as you know, I've mentioned it earlier. It's 20 basis points, or it's 25 with RIA if you wish to use the third-party DFM models in that way. So we think we've got a really nice rounded package that competes well with most of our competitors. And this is the screen that you'll see when you log in to the investment website. Brewin Dolphin showing in this example, but that would easily show Vestra, Brooks, Charles Stanley, whoever they are, when you log in to use those providers. I want to touch on fundamentals because this is a really great addition to what we are giving advisors to use. For those of you who build and still build and manage, develop your own portfolios, what we're saying here is that with Ryan and Simon on the active management side, they interview 200 plus investment managers every year. And usually some research companies will sell you that data, they'll allow you access to that data for a price. What we've been looking at for some time is to bring you access to this data in an efficient way, but B, a cost-efficient way, so that you can access the data that we have. Now, the reason we're making it available to you, this is our data. This is the data that drives and informs the investment decisions that we use to implement our MPS and fund strategies. So we're giving it to you. We're letting you have a look at it, use it. It's now all available with fact sheets and case notes, etc. But we believe that once we've obtained that information, if we're going to stand by it and we're going to ask you to consider our funds, we're going to let you see that data as well. So that data fundamentals piece was launched very recently. If you've not already done so, have a look. The quality of data is superb. And as I say, if you are still running your own models, take a look at it. Why not have a go at a little competition? Run your own models comparatively to the AJ Bell and see where that gets you. Now, platform functionality, usually the thorn in my side when doing the on-the-road seminars, because there's always somebody that wants something that we haven't launched. Now, I'm hoping we've got most of this covered today. There are still one or two things that we've yet to bring to market. But if you look at what we've done, what we've been successful with, and what we've implemented this year, third-party MPS, pre-populated illustrations, the basket of deals functionality I know has gone down exceptionally well with advisors I've already spoken to. Ad hoc proportionate disinvestments and ad hoc online advisor charges. The dashboard, of course, that I'm sure most of you who use AJ Bell Invest Centre are already aware of. And of course, funds and shares too on RIA. Now it says coming soon under new Android mobile app and consolidated emails for corporate actions. Consolidated emails for corporate actions, by the time these go to market, should have already launched, which is fantastic news. It's that single email to advise you about corporate actions relating to multiple clients instead of just a single corporate action for every single client affected. So I'm sure those of you who use the platform will see that as a welcome addition. And for those who don't use the platform, perhaps that's another reason that will make you consider and look at AJ Bell. However, this is what the business is exceptionally proud of. This is, I'll finish off last couple of minutes. And we have just gone through and continue to go through unprecedented times, essentially for businesses that use face-to-face contact primarily to deal with advisors. Working within and through COVID has seen our ability to adapt and really go through the roof. We were mobilised exceptionally quickly to home. Most of our staff were at home within weeks. But this is really, really pleasing feedback from Platforum that AJ Bell, for 80%, received a very good rating for advisors for our ability to adapt to COVID-19. So a great testament to everybody that works at Invest Centre and AJ Bell Group. Customer service, again, in excess of 80% with a very good rating. Personally speaking, as both a member of business development team and a customer of UInvest and Invest Centre, the service has been second to none. It wasn't easy to get that link right to begin with in terms of working from home, telephony contact, email contact, mobilisation to laptops, but as you can see from this research, we've come through this pandemic and continue to push through the pandemic in a really positive way. From a new business point of view, we're still having more and more advisors choose us as their primary platform, which is exceptional. I think in previous sessions I've stood up and we've always played bridesmaid to perhaps one or two other platforms. So it's really encouraging to see Invest Centre, with your support, pushing to the tops of these league tables. And as a result of that, our advisor adoption has just simply continued to increase. So that table I referred to just a minute ago, and to see AJ Bell at the top of this platform table is exceptional for us. It really is. So thank you to everybody for your support. You know, it's 78% as a primary or secondary user. That makes us really, really happy. So thank you very much for the support. For those of you who don't know, this is our contact map. Our BDMs, my team, are always available. Colin Cunningham, Scotland North, Andy Witter, Northwest, James Bell, Southwest. You can read the rest of the names yourself. We have a great team, and supporting that team, we have a business development consultancy team, essentially BDMs on the phone, and supporting both of those teams. Each team is supported by at least one of their own sales support. So we like to think we've got a really comprehensive coverage model in place to make sure we're giving advisors the best service that we possibly can. So it just remains for me to say thank you to everyone who has tuned in. I hope you've enjoyed the session. So it's now time to introduce Kevin Doran, our Chief Investment Officer, AJ Bell Investments. For those who have seen Kev before, of course you realise you're in for a treat. Nothing is straightforward or normal, but a hugely insightful session is due to come. Kev's entitled this session, The Last Dance. And what he said about it is after the upheavals of 2020, he's going to take a delve into the data that surrounds advisor model portfolios. He's going to have a look at the trends, the uses, and perhaps the abuses, and really culminating in a look at what has worked and perhaps what hasn't, before making some predictions on how they'll be crafted in the future. Kev, over to you.
Okay, hello, and thanks for that, Gary. Thanks for the introduction. Yes, okay, so we're going to talk about a bunch of things today, but there will be a unifying theme behind today's presentation. The main thrust of the presentation is kind of what we get up to in lockdown, and also just really kind of how the industry uses data as a whole. We find there's much more data being thrown at us from investments, but also as occupiers and players within the industry. There's much more data available to us, and as we use more and more data, there is a risk that you lose the human element of what we do as an industry. And so it won't just be about data today. We'll talk about humans and the human interaction with data. And what we'll do as a consequence of that is taking a lot of data and our understanding of human beings and advisors and customers, we'll make some predictions about kind of how people manage portfolios and how we think some predictions of how portfolios will be managed in the future. So without further ado, allow me to bring up the presentation. Welcome to my home, by the way. Hope you're enjoying that. And let's kick off. Okay, so today's presentation is called The Last Dance, and that's my first prediction, really. Chances are during lockdown, because we have a reasonable understanding of our customers, during lockdown, you probably had a bit more time on your hands, and you probably, as a consequence, either took out a Netflix subscription or you made a lot more use of that Netflix subscription that you already got. And if you did, again, we've got a reasonable understanding of our customers. There's a good chance that you've caught this thing, which was The Last Dance. If you didn't, strongly recommend that you go and take a look at that. In a nutshell, what are you looking at here? It was 10 episodes, 10 fantastic episodes about Michael Jordan's time at the Chicago Bulls, during which time they won 6 NBA titles, which is a record for a single player to have picked up. And Michael Jordan was absolutely instrumental in the winning of those titles. So if you did spend time in lockdown, good chances that you spent a good bit of time on Netflix, and chances are we'll make the prediction that you probably watched The Last Dance. A safer prediction absolutely is you definitely spent more time on Zoom or Teams calls. That's 100% for anyone who was carried on interacting with customers or even just friends and family over the course of lockdown. Teams and Zoom have been instrumental in allowing us to keep on touch with people. So I feel a lot safer with that prediction. You've definitely spent more time on Teams and Zoom calls, and we'll come back to that one. And as a business ourselves, we had to decide whether we wanted to continue with how we operate. Now, thankfully, we were fortunately in the position where we didn't have to furlough any staff. So every one of our staff has worked throughout the whole of lockdown. We did have to send people home. So from about the 850 people who work at AJ Bell, you could probably expect about 750 people to be working from home at any one period. And in the investments world, we had to make a decision about our intern program. We run an intern program every single year, where we tend to bring in about half a dozen undergraduates, give them a project to do related to investments, and let them come up with the findings. In previous years, we've had the interns who helped inform and did some research on our retirement portfolio service. And if you want some more information on that, or any of our sales guys will be happy to. Last year's crew looked at performance in NPS, and we'll be making some announcements on that in short term. But this year's crew, and let me introduce you to them, this year's crew worked under slightly strange circumstances. So obviously, other than in this picture, they were socially distanced. And they worked predominantly from home. They got together just one day a week within the office, but they worked from home. And given that we knew that they were going to work remotely, we decided what we would do this year's interns is we would set them a data science project. So we went out and recruited lots of data scientists. There's actually some historians and economists in the mix there, but very much numerical disciplines was very much at the fore. We brought these teams together. They'd never met each other before, and we set them the task. And the task was, have a look at the investment value chain and take a look at some of the data sets that we have at AJ Bell. And I'll tell you exactly which data sets it was that we gave them. First of all, we gave them an introduction to our industry. We explained how our industry works as a value chain. So we explained that there's these wonderful people over here who are financial advisors, and these even more wonderful people in our world, which are our customers. And we explained that the interaction on that side of the platform is very much based around financial planning and financial advice. And then on the other side of the platform, it's really about managing clients' portfolios in various wrappers, but the investment management function of how do you bring these people who've got excess capital, who are your customers, how do you bring them in touch with the other side of the fence, which is these companies who are looking to raise capital and looking to offer people investment opportunities. And of course, the intermediary in that relationship is the platform where you manage your clients' portfolios on behalf of those customers in various wraps and in various investment portfolios. And it's the investment portfolios that we really we wanted them to take a look at, and we threw a ton of data at them. So I'll run you through the data that we gave them. So there was over 1,000 lines of individual data within this data set here. But on average, it was advisors, 1,300 advisors who use our books and models too, advising on behalf of, in this case, 32,000 customers. Now, I appreciate that's not a complete customer set for all of those advisors. You wouldn't have a business if you only had 24 customers. So what that tells us is not all advisors use the books and models tool for all of their customers. But on the investment side, what we were looking at here was 15,000 different model portfolios. Individually, 200,000 different securities held within them. Or if you want to look at that on a unique basis, that's over 5,000 unique securities. And those models collectively represented £5.3 billion worth of assets under management or assets under administration. Now, a couple of things jump off this slide, of course, which is 15,000 models for 32,000 customers. That shows that on average, only 2 customers are assigned to each model. And this is one of the themes we'll come back to a couple of times today, which is the data you lose when you only look at averages. What we actually found is we found 2 populations within the advisor set. We found one population of advisors who will create a model for a single client. We'll come back to why you would do that in a second. And then we found advisors who were building portfolios and assigning multiple clients to a single model, which is essentially what the Books and Models tool is designed for you to do, to make your life easier. So what's going on with that other population? And this is the power of incentives very much to the fore. If you are a user of our platform, you'll know that if you use the Books and Models tool to rebalance your client's portfolio, there's no dealing fees. Whereas if you don't use the Books and Models tool, there's a dealing charge for every single transaction. Unsurprisingly, and we're not bothered, it doesn't worry us at all, but unsurprisingly, we found that there are certain advisors who use the Books and Models tool, not necessarily to manage model portfolios, but as a mechanism to avoid the transaction fees. So that's why you've got that two differences of behaviors within there. I say, we're not affected by that. It doesn't bother us. It's a feature of the platform. But on top of that, what it does is, in doing so, it helps you to manage your client portfolios more efficiently, but also we get an insight into how you build model portfolios, not just for your bulk clients, but also for some of your more bespoke clients. And the 5,000 unique securities demonstrates another power of incentives, which is if you offer people an open architecture platform, they will absolutely use it. Now, the other thing that drops out of this is the typical customer size here, so £5.3 billion over 32,000 customers. That gives you an average portfolio size of about 165,000. That's slightly lower than the industry average of an advised customer. But it does certainly show that the models and the portfolios and the clients that are involved in this data set are certainly representative of not just AJ Bell customers, but the industry at large. And we think there are some takeaways that we will come to in a second, which don't just apply to advisors who use the AJ Bell platform, but the industry at large. But before we get to that, I do want to make a caveat. And the caveat is, whilst we think the customers are representative of advised customers in the UK, the firms involved are not necessarily representative of the advised firm population in the UK at large. What you tend to find with AJ Bell advisors is it tends to be more skewed towards smaller operations and skewed in particular towards smaller sole traders. So in the population data set that we're looking at here, almost 70% of the advisors in the data set are sole traders. So that's of the 13,000 advisors in here, 900 of those firms are individual sole trader accounts. Now that contrasts with industry average numbers of around 45% of advisors in our industry are sole traders. And so you can see here there is a bit of a skew towards smaller and sole trader operations. Actually, I think that it gives us a much richer data set, but I think it's the only caveat we need to make about making extensions of our data set to the whole advisor and customer community. And we said to the interns, the story is hidden within this data. If anyone's read Freakonomics, you'll know that whenever you give anyone a large data set, there's always interesting stories to be had there. And they told us some things that we absolutely knew, and that's very much represented on this slide here, which tells us what everyone knows, and I'm sure you all know, that taking advice about your investments is very much something that you do in later life. It's something that tends to peak around the age of 60, and you'll know that people only really genuinely get interested in taking advice on their investments typically once they're past the age of 50, and certainly as they get closer to 55 and the ability to access their pensions, for example. They're normally the triggers that encourage people to take financial advice. And of course, as you go into later life, we tend to lose more customers, and that's why you've got this kind of really symmetrical ownership here. I will touch on very quickly what's going on towards the very younger end there. Of course, your customers are not these 10 and 15-year-olds. They are, of course, the children and the grandchildren of your actual customers, but you're managing that money on the behalf of the beneficial owner in ISA, in JISAs and junior SIPs, for example. And of course, they represent beneficial owners, and so we're showing them on this chart here as being clients aged 0 to 20, for example. But of course, we understand the relationship of what's actually going on there. They also told us that as you get older, you tend to become more wealthy. And your wealth, again, also tends to peak around age 60, at which point people go into glide path modes and then eventually into decumulation. And so kind of we stylize the information here to make it easier to represent. You can see almost a textbook example of what you would expect to see in terms of portfolio value when you look at a customer's age. It will tend to peak around the age of 60 as people start to go into glide path and decumulation mode. And really, you don't really start to accumulate any wealth until you're well into your 30s and 40s. But what's really interesting, and again, it's textbook, is that chart there from about the age of 35 to 85 is symmetrical. And so that's that's interesting. Again, an adage that most people know, which is your wealth aged 85. A good predictor of the wealth you'll have at age 85 is the money that you had when you were 35. It does tend to be a symmetrical distribution. But there's a couple of areas where this doesn't match up with the textbook. And in particular, it's this little hook towards the end as we get to the, like the really older portfolio. If this was a textbook example, you would expect that line to keep on going down as clients got deeper and deeper into decumulation. What we actually found in this world was there was two sets of data, again, two different populations which are characterized by the average, but there's a larger dispersion of behaviors towards that end of the spectrum. And the two behaviors we found were people who, yes, were genuinely in decumulation, but what we also found was a significant number of portfolios where almost the mandate of the clients had changed from looking after themselves as they got into later life. And it was now by intergenerational transfer of wealth. It was, how can I preserve the capital for my children or even my grandchildren? And as a consequence of that, what you tended to find was there were actually more people who were preserving capital for future generations than they were going into deep decumulation. And that's why you start to see this flick up in the average value of the portfolio once you get into that 90s and 95 kind of territory. And the other area that kind of jumps off the page here is this little group of investors in their late 20s and early 30s who seem to have disproportionately large portfolios. And again, these are average values that we're looking at here. What's actually taking place here is there is a subset, a subpopulation of those 15,000 clients. There's a subpopulation there in this age group who've got so much money that it actually drags the overall average up. And actually what we found when we delved into that, there was about 250 professional footballers within this population data set. And of course, these professional footballers, aged in their late 20s and early 30s, what they are actually doing, they're actually really close to their retirement age. And so you would expect them to have accumulated much more money at that sort of age range, because actually in their investment journey, they are rapidly approaching retirement, and therefore you've got a significantly higher average portfolio size in that data set, and it's enough to skew that data for that age group and drag it off the stylized sort of numbers there. So, there's lots of little stories within here. I think one of the takeaways from this is, when you're thinking about prod and target markets, and I'm sure you either have done that exercise or you're still going through that exercise now, professional footballers and professional sports people probably do represent a individual specific target market. And that's probably something based on the evidence that we see in our data anyway. They are so statistically significant from your average clients that you probably ought to be thinking about a different proposition for them than your standard, depending on kind of how you're cutting your proposition. It should differ from your standard 30-year-old proposition, or it should differ from your standard 60-year-old proposition of someone who's come rapidly approaching full-on retirement. That's something that we thought was relatively interesting. But what was way more interesting is when you start looking at this information. And so we've stylized this information now based on the age and the value of the portfolio. And of course, they're strongly correlated. The age of the client strongly correlates to the size of their portfolio. But it actually, when we look at what happens within client portfolios themselves, we find that it's either the age or the value of the portfolio that is the main determinant behind how you as financial advisors are building your model portfolios. And that's the data that I want to take a look at now for much of the remainder of the presentation. So the first one we'll take a look at is, let's cross-correlate this portfolio value by age. And now let's have a look at all of those individual model portfolios that I talked about earlier. Let's take a look at some of the variables, the sub-variables within those portfolios. And what I've done here is I've cross-correlated the value of the portfolio by age versus how much of that portfolio is in multi-asset products. And again, if we stylize that information just so it's easier to kind of understand what's going on here, if we have a look at the line of best fit, what we see here is, as the portfolio becomes larger and more mature, the value of assets held within multi-asset products tends to decline. So we're seeing a transition here as the client gets older and as their portfolio gets larger, we're seeing a transition of, for smaller, younger portfolios, we're seeing much more prevalent use of multi-asset products. And as the client gets older and the portfolio size gets larger, we see a transition to single strategy portfolios. So much more use of single strategy products. When it's still built in a multi-asset fashion, but much more use of single strategy products within a multi-asset portfolio as the client gets older and as the portfolio size gets larger. But notice that the multi-asset starts to increase as the client gets older. That tells us that it's not a function of age which is driving this behavior within the portfolio. It's a function of size. It's not a linear relationship. It's a wave relationship, and as a result, we can pretty much say with strong predictive power that the size of the portfolio will be a strong predictor of how much of the portfolio will be held in multi-asset portfolios. Now, of course, we've spent time not just looking at data, we've spent time talking to advisors like yourselves. And so we know this is not just data that's telling us, we understand the mechanism by which this is happening. And of course, when we speak to advisors, what we're finding is that your smaller client proposition will tend to be more driven by multi-asset funds and multi-asset products like MPS. And then your larger portfolios are more likely to be a combination of single strategy products. And again, we see a transition from multi-asset funds to MPS, where you see you kind of like the client gets to see more of the single strategies in there. And then as the portfolio starts to decline in value, we see a reversion back into multi-asset portfolios. So this is definitely a function of size of the portfolio, not the age of the client. Whereas if we transition now and have a look at the value of the portfolio held in active products, we see that this linear relationship here, it keeps on going up as the client gets older. It would appear that the main determinant of the use of active portfolios tends to be not the size of the portfolio, but the age of the underlying client. And again, we're trying to understand the mechanisms as to why that behavior would exist. And we think we've got an explanation for this, but by all means, give us your comments and your thoughts yourself. But what we think actually is happening here is the more older clients, there was some correlation between the age of the client and the age of the advisor. And so what we think we're seeing here is the age of the client is a small predictor of the age of the advisor. And we think what we're seeing here is the age of the advisor will be a better predictor of how much of the portfolio is held in active funds versus passive funds. So we think that's the mechanism which demonstrates this relationship that we're seeing here. And then the final one I'd like to take a look at is the use of alternatives within portfolios, which we found really quite interesting as well. And again, what you've got here is a linear relationship, which is, i.e., as the client gets older, what we're seeing here is more and more alternative assets tend to be used in portfolios. And I go back to what I said before, which was as we found the older clients and remember that little flick up in the data that I talked about before. What we're seeing here is, as clients are seeking to preserve the capital value of their portfolios for future generations, what we think we're seeing here is more and more alternative asset classes are being used in order to try and generate that capital preservation element. And when you drill deeper into this data, that's exactly what we did see. We saw in particular much more prevalent use of hedge funds and absolute return bond funds for older clients, where the objective seems to be to try and preserve the value of the portfolio for future generations. And so kind of think of the three things that we've looked at there. We've looked at the use of multi-asset portfolios, the use of active products, and the use of alternatives within underlying portfolios. You might well ask yourself, okay, well, why have you only looked at those three areas in particular? Now, the truth is, the intern looked at pretty much any variable they could get their hands on. The reason I've focused on these three portfolio characteristics in particular is when they also looked at the portfolios and they looked at the OCF, the cost of the portfolios. This is the underlying cost of the investment for these individual model portfolios. So it doesn't include wrappers and platform costs. It doesn't include advice fees. This is just the underlying synthetic OCF of managing these portfolios. Again, we get a very linear relationship. And the linear relationship is a function not of age, but it's a function of those three areas that I talked about before. And so we're able to regress this information and get an idea of, make a prediction of what the cost of the portfolio will be. And the predictive equation is, if you were to use no alternatives, no multi-assets, and no active products, the cost of the portfolio would be 0.35%. But for every 1% of multi-asset portfolios that you use, that adds another basis point to the cost. For every 1% of alternatives that were used in portfolios, that added 1 basis point to the cost. And for every 1% of actives held in portfolios, that added 7 basis points to the cost. And what the team were able to do is they were able to say, okay, well, if they are the key determinants about the cost of the portfolio, these are the value-added elements of the portfolio, we can now look at the performance of every one of these model portfolios and regress that information and see whether you got any value for your money effectively. And we did this, appreciating this is a very short time frame that we looked at, and so kind of I will caveat everything I'm about to say with that precursor. But what we did is we got the interns to look at the performance of these model portfolios over 6 months, and all the data was to end of June, by the way, so the first 6 months of 2020. We got them to look at the data of the performance over the past 12 months, so from June 19 to June 2020. And we also got them to look at the performance of the data from the middle of February to late March. And the reason we chose that data range in particular was that was the peak of the markets in February to the maximum drawdown, which was late in March. And so we've looked at the performance of these model portfolios under 3 different scenarios. A pretty flat market, an upward market over 12 months, and a strong drawdown during February to March. And what we found was this, which is the multi-asset portfolios, so those portfolios with multi-assets within them, did tend to outperform the more single strategy elements, single strategy driven portfolios. So multi-asset funds, yes, cost you a little bit more, and of course they cost you a bit more because you're paying for asset allocation, but it did tend to lead to slightly better circumstances across all three time periods, by the way. The alternatives added very little over 12 months, nothing at all. There was no statistical advantage over 6 months. But during the drawdown period, there was a small positive contribution from alternatives during the drawdown period. And that was very much driven by, as I say, if you ever look at the alternatives and drill into that, the main alternative asset classes that we saw people using were property, which didn't help at all. We saw people using absolute return bond funds, which did help during the drawdown period. We saw people using hedge funds and structured products and some commodities, and those latter three had no discernible benefit whatsoever. But during the pull down period, during that drawdown, we did see that the absolute return bond funds in particular did add some value. But when we went to actives, whether it was over 6 months, whether it was over 12 months, or whether it was over the drawdown period, unfortunately, we didn't see any positive contribution from the active elements of the portfolios versus those that didn't happen. So these are all controlled data sets and lots of data. I'm not saying that some active portfolios didn't outperform, they absolutely did. But on average, active portfolios gave no positive contribution in any three of those periods, but they did make a positive contribution to the cost. Now, of course, if you're part of the evidence-based investor group, that's Robin Powell, etc. And I've got nothing against Robin. That's not a slight against Robin, but your head's kind of blown at this stage. It's kind of, you've got statistical data which says that it costs your clients more to use active portfolios, and it's had no discernible benefit. Why would you pay for that if it's had no benefit? And equally, why are you using alternatives when it really only worked during the drawdown period? Now, that's not our view. Our view is, and I go back to what I said at the start, which is when we look at data, we never just look at the numbers. We always look at data through a human lens. We understand the humans, and we look at data to try and tease out behaviors, but then we try to understand the human element to understand what's the mechanism by which that behavior is occurring, and that will help us to make predictions about how people and human beings will behave in the future. And so what I want to do now is I want to take a look at why evidence-based investors see this sort of thing and their heads is blown, but why at AJ Bell we look at this through a slightly different lens. And I want to go back to that Zoom call that I mentioned earlier, and let's look at this through the lens of some professional basketball players. This is about numbers, but it's always about people as well. And so anyone who did watch The Last Dance will know that Mike Jordan is arguably the greatest basketball player of all time. And we can pretty much prove that because, as I mentioned before, if you have a look at the number of NBA titles that Michael Jordan won, he won more NBA titles than any other player in history. And so if we were playing top trumps, and again, I'll make a prediction of, you're probably, if you're listening into this, you're probably over the age of 40. You probably grew up in the UK. And so you're probably also familiar with the game of top trumps. And if you know anything about top trumps, you know that the aim of the game is you get a deck of cards and you play against your competitors. Well, you choose a category, and the person with the best score is the top trump and takes all of the cards in the hand. So if you were playing top trumps, surely you want Mike Jordan to be in your hand. He is the top trump on every category, isn't he? Surely he is. Now on NBA titles, absolutely Mike Jordan beats everyone hands down. If we go to season most valuable players, so this is who is voted as the most valuable player throughout the entire NBA season. Again, Michael Jordan wins that one as well. So 5 times Michael Jordan was season MVP, pushed hard by LeBron James, who you've probably heard of. Kobe comes in with only 1. Shaquille O'Neal, who again you've probably heard of, only comes in with 1. Rick Barry never won any, and Will Chamberlain, who we'll come on to in a second, won 4 season MVPs. But what about points per game? Well, again, any basketball fans in the audience will know that in the modern era, Mike Jordan scored more points per game than anyone else. In fact, he was, in the modern era, the only player ever to score more than that average of 30 points per game. But he's not the highest point scorer ever. That title goes to a guy who you probably never heard of, called Wilt Chamberlain. Now, Wilt Chamberlain played NBA basketball in the 1960s. And he had an average score of slightly better than Michael Jordan of 30.2. Now, on just about every scoring record, Wilt Chamberlain is your top trump. He's the only person ever to score 100 points in a game of basketball. And in the 1961-62 season, he scored an average of over 50 points per game. Now, what makes that much more incredible is, and why he's not credited with the highest point score of all time, is he didn't do this in the modern era. But I think it makes it more impressive because the modern era, the delineation between the two is when the three-point line was put in, which was in the NBA in 1979. So Wilt Chamberlain scored more points than anyone else in history on a basketball court and never even had the chance to score a three-pointer. Now, we have looked at conversion statistics. So, for most NBA players, they score about 1 in 3 of their three-point opportunities. So if you go for a three-pointer, statistically, for every three-pointer you go for, you score 1 point. Unless, of course, you're Shaquille O'Neal. So Shaquille O'Neal, huge guy, great basketball player, but couldn't shoot at all. He was great at going to the basket, he was great at layups, great at dunks, but he couldn't shoot at all. Absolutely woeful statistics when it comes to three-pointers. And he was also rubbish when it came to free throws. Now, free throws are really important in the game of basketball, particularly later on in the game. And again, I make the point about Wilt Chamberlain. What makes Wilt Chamberlain really, really impressive is he got the highest point score ever. He was rubbish at free throws, and he never had the opportunity to throw a three-pointer in his life, but still scored more points than anyone else. Now, Wilt Chamberlain's a really, really interesting guy when it comes to free throws. Wilt Chamberlain knew he was rubbish at free throws. And so as a result, he adopted a style, which was when free throws were first brought into the game, all you had to do was start from behind the free throw line, which is 15 foot away from the basket. Wilt Chamberlain was such an athlete, he was 7'1", was a phenomenal athlete. He could jump from the free throw line 15 foot away and dunk the basket. And the NBA decided that was unfair on everyone else who couldn't possibly achieve that piece of athleticism, that they changed the rules. And it was one of 2 rules that were changed in NBA basketball because of how good Wilt Chamberlain was. Now, most players in the NBA will score about 75% of their free throws. Mike Jordan and Kobe were better than average free throwers. But the best of all time was this guy called, again, who you've probably never heard of, called Rick Barry. And Rick Barry was a decent free throw thrower until he changed his style. And you've got a clue as to why Rick Barry was such a good free throw thrower on the slide here. He changed the style. Now, they did change the rules so that he can't run and jump from the free throw line, but no one said anything about how you throw the ball. Most players throughout NBA history do the standard overarm throw at the basket. If your granny was to throw a was to throw a free throw conversion, she wouldn't throw it overarm, she'd throw it underarm. And Rick Barry decided that he was going to try and throw his free throws underarm. And what he didn't know the science behind this, but what he was able to demonstrate was that is statistically more likely to give you a better outcome than throwing it overarm. And there's a bit of an analogy here of kind of like active management versus passive management. We can demonstrate using science, and indeed in 2017, scientists from Yale and Harvard University showed using mechanical engineering and physics that the most optimal way of throwing a free throw is to actually throw it underarm. Rick Barry didn't know this, other than it just worked for him, and he scored more free throws than anyone else. The most optimal way of throwing a free throw is to throw it underarm. And again, I make this analogy of we can statistically demonstrate, and the science actually in this case shows that throwing underarm is better than throwing overarm. But there's human beings involved. And the human beings will take a look at kind of the different strategies, and they will form their own opinions on those different strategies. There are currently only 2 NBA players who throw their free throws underarm. And one of them is Rick Barry's son. Now, when you throw a free throw, it's done in public. Everyone can see how you're throwing your free throws. And so there's a certain element of conformity and peer pressure about how you do that. Let's go back to Shaquille O'Neal just to demonstrate how the human element can often override the statistical component. Shaquille O'Neal was playing basketball throughout a lot of the early 2000s. And Shaquille O'Neal could have potentially been the greatest basketball player of all time, except he never got to play late into the game because he was so bad at free throws, which is when free throws become really important in the game, that he was pulled off the court. Rick Barry could see what was going on here, and he approached Shaquille O'Neal and said, would you like me to teach you how to throw underarm? It's called the granny shot. Now, in 2017, Shaquille O'Neal, after that science paper was published, was interviewed by the Business Insider magazine. And they were talking about, Shaq's really awful free throw record. And they asked him the question, why didn't you ever try the granny shot? Why didn't you ever try to throw this thing underarm? It was Shaquille O'Neal's response, because it's boring. I don't care about the statistics. I care about how it looks. I didn't do it because it's boring. The Business Insider interview came back, but what about the science? It's proven to be somewhat effective. And here's Shaquille O'Neal's response. No, it's not. Just because a couple of guys did it doesn't mean anyone can do it. And then recounting his conversation with Rick Barry, I told Rick Barry I'd rather shoot 0 than shoot on the hand. And just to emphasize his point, I'm too cool for that. So whether you're Shaquille O'Neal, whether you're Mike Jordan, whether you're Rick Barry, we don't care. We're here to offer you investment solutions. So whether you want to be active management, whether it be passive management, whether it be passive management, we know that you will have your own personal preferences on how you manage your clients. And the financial advice and the financial planning is far more important than the investment implementation. And that's why investment implementation needs to be commoditized. And that's why we take a commoditized approach at AJ Bell. That's why we price it as low as we do at 15 basis points. The value in the value chain doesn't reside in the investment solution. The value in the value chain rests in the financial advice and the financial planning. When it comes to implementing your client's portfolio, we know that you and your clients will have their own personal preferences. And that's why we offer active, we offer passive, and we offer passive portfolios. But my final words, if you'll indulge me, is let me just have a think back to that stuff we talked about on multi-asset portfolios, because I thought that was really interesting. In all 3 scenarios, the multi-asset portfolios, which yes, cost a little bit more, in all 3 scenarios led to better outcomes for clients. I just thought that was an interesting kind of takeaway. And so we are seeing more and more people adopt multi-asset outsourced investment solutions, whether that be multi-asset funds or multi-asset MPS. We are fortunately now in a position where we have a 3-year track record on our multi-asset solutions. And in particular, if I look at our multi-asset funds, which have now got a 3-year track record, you'll see if you take a look at the performance in the 3 years since we launched those funds, have a look at the quartile ranking. Every single one of those funds in the 3 years since we launched those products were in the first quartile of their IA sector. Now, they are passively managed, but they are first and foremost, they're multi-asset solutions. They're simple, transparent, and more importantly, low cost multi-asset solutions that allow you to implement on behalf of your clients. And so if you are using multi-asset funds as part of your investment toolkit, all I would ask, it's my only request today, is that you take a look at the AJ Bell multi-asset funds versus maybe some of the multi-asset funds that you're using elsewhere. Because I'm reasonably confident that if you are to go away and do that research, you will find that not just are our costs lower than the vast majority of everyone else in the marketplace, but our performance has actually been better than the vast majority of everyone in that database. So that's my one and only request today. Thanks for listening. Hopefully that's been relatively interesting to you. And my final request is, please go and take a look at our funds.
Kev, thanks as always for that great session. I hope everybody online has enjoyed the session, So a huge thank you for joining us for day one of day two of this series of AJ Bell on the road, off the road seminars. Tomorrow we will hear from Russ Mould, our technical director, who will supply us with, as always, his own views on markets and all things economics. And that will be followed by Lisa Webster, our senior technical consultant, who will give us a full update on regulation, all things pension and technical news. CPD certificates will be made available in the usual way. And it just remains for me to say a huge thank you for joining us. Please complete the feedback session, the feedback forms, I should say. They are hugely important and do help us inform in terms of future sessions, content and speakers. Thank you very much.